If the Fed prints money, who do they owe it to? Here's a question that breaks the minds of even the most seasoned economists. The Federal Reserve creates trillions of dollars out of thin air. Literally. Numbers flicker on a screen, no gold, no assets, no deposits, just pure digital magic. In 2020 and 2021 alone, the Fed conjured $6 trillion from the void. Think about that for a moment. $6 trillion generated with the click of a button. It wasn't mined in some remote field. It wasn't earned through labor or trade, and it wasn't borrowed from any lender. It simply appeared. Yet every single dollar bill in your wallet boldly declares itself a Federal Reserve note. And what does that mean? A note is a promise. It's a debt instrument, a binding promise to pay someone back. When you sign a promissory note for a car loan, you're pledging to repay the bank. That note is a symbol of debt. So, logically, if every dollar is a Federal Reserve note, every dollar in existence is at its core debt. Someone owes that dollar to someone else. But here's the mind bender. If the Federal Reserve creates money out of nothing and those dollars are debt, then who exactly does the Federal Reserve owe? There was no lender, no one handing over cash to lend out. So, who is the creditor? This question pulls back the curtain on the entire American monetary system, a system carefully engineered not just to manage money, but to channel wealth upward from the public into private hands. Because, as it turns out, the Federal Reserve doesn't owe the money to anyone. Instead, the United States government owes the money to the Federal Reserve. And the Federal Reserve is not a government agency. It's owned by private banks. This means your government borrows money that was created from nothing and pays interest on that debt forever to private banks. And who ultimately foots the bill? You, through your taxes. This, right here, is one of the greatest financial cons in history. A vast, hidden mechanism that's quietly transferring wealth from the people to private bankers for over a century. Most Americans have no idea this system exists. But before we can unpack this mystery, before we can even begin to understand who the Fed owes, we need to answer a more fundamental question. What is the Federal Reserve? Because everything you think you know about it is probably wrong. Most people assume the Fed is a government agency, like the Treasury Department or the IRS. It's not. The Federal Reserve is a private banking cartel, created in 1913 by the Federal Reserve Act, designed by bankers for bankers, to give them control over America's money supply. Here's how it's structured. The Federal Reserve System is made up of 12 regional banks in New York, Chicago, San Francisco, Philadelphia, Boston, and others. Each of these 12 is a private corporation, not a government office. They have shareholders, and those shareholders are the biggest commercial banks in America: J.P. Morgan Chase, Citibank, Bank of America, Goldman Sachs, Morgan Stanley, the very institutions that dominate Wall Street and finance the global economy. The New York Fed, the most powerful of the 12, handles all the critical open market operations. It's literally owned by these banks. On paper, there is a board of governors in Washington, D.C., 7 members appointed by the president and confirmed by the Senate. This board sets policy and creates the illusion of government oversight. But the regional Federal Reserve banks, owned by private banks, hold the real power. They create the money. They hold the assets. They dictate the flow of credit. Here's where it gets even more astonishing. Every commercial bank in the Federal Reserve System is legally required to buy shares in their regional Fed bank. J.P. Morgan Chase, headquartered in New York, owns shares in the Federal Reserve Bank of New York. These shares pay a guaranteed 6% annual dividend, risk-free no matter what the economic climate. That's right. Before any profits go to the Treasury, the Federal Reserve is legally obligated to pay private banks 6% every year. The Fed is not just a government function, it's a profit-making institution owned by the very banks it regulates. Let that sink in. A private banking cartel creates money from nothing and then charges the government interest on that money, and the government, funded by your tax dollars, pays. Why would the government hand over the power to create money to private banks? This is the core of the scam. In 1913, the largest banks in America, led by J.P. Morgan, the Rockefellers, and the Rothschilds, lobbied Congress hard to pass the Federal Reserve Act. They pitched it as a way to stabilize the economy and prevent bank runs, citing the chaos of the Panic of '07. There was some truth to that. The 1907 panic exposed the fragility of the U.S. banking system. But what they really wanted was control of the money supply, because whoever controls money controls the economy and ultimately the government. Before 1913, the government could create money directly. After 1913, the government was forced to borrow money from the Federal Reserve, a private cartel. This was the largest transfer of economic power in American history, and most Americans never realized it happened. So how does the Federal Reserve actually create money? The answer lies in a deceptively simple yet profoundly impactful process. A process few understand and fewer still question. Picture this. The U.S. government needs to spend $5 trillion in a year, but tax revenues only cover $3 trillion. That leaves a yawning $2 trillion deficit. To fill this gap, the Treasury issues bonds, essentially IOUs promising to repay the borrowed money with interest. Who buys these bonds? Foreign governments, pension funds, mutual funds, commercial banks, and, crucially, the Federal Reserve itself. When the Fed decides to purchase $500 billion of these bonds, a maneuver known as open market operations, it doesn't reach into a vault or transfer existing cash. Instead, it conjures $500 billion out of thin air. With a few keystrokes, the Fed credits the Treasury's account electronically. No gold is moved, no assets exchanged. This is pure digital creation of money. This is the moment the myth shatters. Money isn't printed because of economic productivity or tangible wealth. It is created at the will of a private banking cartel and then lent to the government, which must repay it with interest. But who owns this power? Not the government, not the people. The ownership lies with the member banks, the giants of American finance. J.P. Morgan Chase, Citibank, Goldman Sachs, Morgan Stanley, Bank of America own shares in the Federal Reserve Bank's regional banks. These shareholders elect 2/3 of the directors on their Federal Reserve Bank boards. These directors appoint the presidents of the regional banks, who in turn sit on the Federal Open Market Committee, the body that shapes America's monetary policy. A circular system. A circular system. A system designed to ensure that private banks hold control behind a veil of government legitimacy. Consider this carefully. The Federal Reserve is required by law to pay these member banks a fixed dividend, typically 6% annually, regardless of economic conditions. In 2023, the Fed made roughly $58 billion in profit. Out of that, about $2 billion was paid out as dividends to these member banks. The remainder, around $56 billion, was sent back to the Treasury. At first glance, this might appear to be a generous contribution to the public coffers. But remember, this profit comes from interest on government bonds bought with money created from nothing. The government borrows money from the Fed, which creates it from thin air, and then pays interest on that debt. Your tax dollars fund these interest payments. Follow the money trail. The Fed creates $500 billion out of thin air and buys Treasury bonds. The government receives $500 billion in cash, which circulates in the economy, paying salaries, funding programs, keeping businesses afloat. But the government now owes $500 billion plus interest back to the Fed. Assuming a 3% interest rate, that's $15 billion a year. Where does the government get that $15 billion? From tax revenue. Income taxes, payroll taxes, corporate taxes, all funnel money from the people to cover the government's interest payments.
Over $1 trillion of federal tax revenue goes annually to paying interest on the national debt, money that could instead fund infrastructure, healthcare, or education. And here's where the system's brutal elegance becomes clear. In 2023, the Federal Reserve held around $5 trillion in Treasury bonds. With an average interest rate between 2 and 3%, the Fed collects roughly $100 to $150 billion in annual interest income. What happens to that money? First, the Fed covers operational expenses, salaries, buildings, technology, about $5 billion a year. Next, it pays the 6% dividends to member banks, around $2 billion. Some funds are held as surplus capital. The rest, tens of billions, are sent back to the Treasury. But the key truth remains: this vast sum of interest is paid on money created from nothing. This relentless flow of interest from taxpayers to private banks is the greatest wealth transfer of our time. You work hard, you earn a paycheck, you pay your taxes. Your tax dollars go to the Treasury. The Treasury pays interest to the Federal Reserve. The Federal Reserve profits, and its owner banks reap guaranteed dividends. This mechanism has been quietly operating for a century, transferring trillions of dollars from the public to private banks, fully legal, fully baked into the law, and fully hidden in plain sight. But the greatest shock is yet to come. The national debt, currently over $36 trillion, can never be fully repaid. This isn't due to political incompetence or overspending. It's a mathematical certainty baked into the monetary system. Every single dollar in circulation was created through the Fed buying government debt, mostly Treasury bonds. If the government were to pay off all its debt, it would have to collect every dollar in circulation through taxes or other means, then return those dollars to the Federal Reserve. When the Fed receives those dollars and cancels the bonds, the dollars themselves disappear from the money supply. Paying off the debt reverses the creation of money. The money supply would plummet. No dollars would remain. No wages would be paid. No goods could be purchased. The economy would collapse instantly. This is why, since the Federal Reserve's inception in 1913, the national debt has grown nearly every year, because the system requires ever-increasing debt to sustain the money supply. As the economy grows, more money is needed, and the only way to create more money is through more debt. It's a vicious cycle: perpetual debt, perpetual interest, perpetual wealth transfer. The trap tightens when we consider the nature of interest itself. The Federal Reserve creates, say, $500 billion in new money to lend to the government. But the government doesn't just owe $500 billion. It owes $500 billion plus interest. That interest was never created alongside the principal. Where does it come from? It has to come from existing dollars in circulation, meaning for the government to pay that interest, someone else must go into debt, or the government must borrow even more. This creates an exponential spiral, an ever-growing mountain of debt. If the Fed creates $500 billion, but the government owes $515 billion, including interest, there is a $15 billion shortfall. To cover that, new debt must be created.
This cycle never ends. Debt grows faster than the money supply because interest is not created with the principal. It's a mathematical certainty. That's why the national debt stands at $36 trillion today, and why it grows by roughly $2 trillion each year despite almost $5 trillion in annual tax revenue. The numbers don't add up. Because the system isn't broken. It's designed this way. Permanent, unpayable debt generating permanent interest payments. Every dollar of interest is wealth siphoned from taxpayers to private banks. Throughout American history, a few presidents recognized this dark mechanism and dared to challenge it. Their stories are warnings etched in history. In 1835, Andrew Jackson did what no other president has. He paid off the entire national debt. How? By refusing to renew the charter of the Second Bank of the United States, the central bank before the Fed. Jackson called it a den of vipers and thieves, vetoed its recharter, and watched it die. With no central bank creating debt-based money, Jackson used revenue from land sales and tariffs to clear the debt. For a brief shining moment, America was debt-free. But the aftermath was brutal. The Panic of 1837 hit, a massive economic depression. Why? Because without new debt, the money supply contracted. The economy collapsed. Jackson's experiment proved a painful truth. In a debt-based monetary system, eliminating debt means destroying money. You cannot have one without the other. Fast forward to 1963. President John F. Kennedy signed Executive Order 11100, authorizing the Treasury to issue $4 billion in silver certificates, government-issued money bypassing the Federal Reserve. These notes said United States note, not Federal Reserve note. Debt-free money, created by the government. But 5 months later, Kennedy was assassinated. His successor, Lyndon Johnson, halted the issuance of these notes. The $4 billion disappeared quietly. Was it coincidence? Maybe. But presidents who challenged the banking cartel often met tragic ends. Abraham Lincoln issued greenbacks during the Civil War, government debt-free currency. He was assassinated. James Garfield spoke openly about the dangers of private control over money. He was assassinated within months. These are not conspiracy theories. They are documented facts. The system fights to preserve itself. So, returning to our original question, if the Federal Reserve prints money out of thin air, who do they owe it to? The answer is no one. The Fed creates money from nothing. There is no lender, no creditor. They are the source of dollars. But the government owes the money to the Fed, and the Fed is owned by private banks. The chain of debt is clear. Private banks own the Federal Reserve. The Fed creates money from nothing. It lends this money to the government. The government owes the Fed. You pay the government through taxes. The government pays interest to the Fed. The Fed pays dividends to its owner banks. You work, the banks profit. Every dollar in your wallet is a Federal Reserve note, a debt instrument. You hold evidence of debt owed by the government to private banks. That debt can never be fully repaid, because if it was, there would be no money. The system requires perpetual, exponentially growing debt, permanent interest payments, and a continuous transfer of wealth from taxpayers to banks, a transfer that has run for over a century. Since 1913, this mechanism has quietly siphoned trillions of dollars from the American people to the banking elite. Most remain unaware. They think the government prints money. It doesn't. The Federal Reserve, a private banking cartel, creates money and charges the government interest forever. The national debt climbs ever higher. Your tax dollars keep paying interest to the Fed and its owner banks. Who really runs America? Not the president, not Congress. It's the banks, the ones who own the money printer. They create the money, they collect the interest, and you pay the debt. Understanding the true nature of the Federal Reserve is to glimpse the hidden engine that drives modern America's economy and its inequalities. It's a system built on debt, on control, on the promise of growth fueled by ever-expanding money created from nothing. A system where power flows not from votes or laws, but from ownership of the money supply itself. The same banks that sparked the 2008 financial crash, the same ones bailed out with trillions of dollars, are the very banks that own the Federal Reserve. They profit from every dollar of national debt. This is not a flaw, it is the system's design. The Federal Reserve Act of 1913 was the greatest financial heist in history. It transferred the sacred power to create money from the people's government to private banks. Banks given the legal right to create money out of thin air, lend it to the government, charge interest forever, and collect guaranteed dividends regardless of economic turmoil. The implications are staggering. The government's hands are tied, forced into borrowing from the Fed to sustain spending. Taxpayers bear the cost through endless interest payments, and the wealthy owners of the Fed grow richer. Look closely at your wallet. Every Federal Reserve note is a symbol of this vast, invisible debt. Every dollar is a link in the chain binding citizens to an endless cycle of borrowing, repayment, and wealth transfer. And yet few ask the question, who really owns our money? Who really controls it? The truth is uncomfortable, but necessary. The money supply is not a neutral tool for economic growth. It is a lever of power wielded by private interests for private gain. This system has shaped the course of history, influenced wars, dictated policies, and controlled the lives of millions. Understanding it is the first step towards reclaiming economic sovereignty. So when you hear talk of the Federal Reserve printing money, remember, they don't owe it to you. They don't owe it to the government. They owe it to no one. But you, the taxpayer, owe them. You pay the bill. You feed the machine. And this has been going on for over a century. This is not just a story about economics. It is a story about power, about control, about the invisible forces shaping our world, and about the urgent need to question who truly holds the keys to the kingdom. Because understanding the Federal Reserve is understanding who really runs America. If this changed your perspective, if it opened your eyes to the hidden realities beneath our economic system, then share this story. Because knowledge is the first step towards change. If you have any questions or requests for future topics, please let me know in the comments.